Welcome, everybody. It's June 25th. Here's our June coaching calls. All trading involves a substantial risk of loss and is not suitable for all traders. I'm not a broker. This is not financial advice. This is not a recommendation to buy or sell any particular financial instrument. And past performance is no guarantee of future results. The stuff that we talk about here might work today. It might not work today, and it might work tomorrow. And it might not work tomorrow, but it might work today. And if you need personal financial advice, you should consult a financial advisor. Okay, June 25th, 2020. Happy to see you here. The bounty spreadsheet is in full swing. We're going to take a look at Vonage, posted by Ann. Thank you so much. And then just a reminder on the bounty spreadsheet, do a Google search for the company and the earnings transcripts and post the most recent earnings transcript link inside the whatever. So I just Googled Vonage earnings transcripts, got the Seeking Alpha link. And so I can just copy and paste that link in there. And that makes it easy for me to get up early in the morning and read transcripts, which is exactly what we're going to do today. So Vonage is an interesting stock because it is trending upward during the crisis. And if you think about Vonage, it's one of those voice over IP situations where the company provides phone services over your internet connection. So you can have a business line with just an internet connection. You don't need the phone company in order to have a business line or even a personal phone line and whatever else. And they do video and a bunch of other things now. So it makes remote work more easily doable. And so it's in an uptrend. It's good for remote work. We look like we may be entering a period of another kind of shutdown situation. And that's definitely interesting. So what we want to do is take a look at the fundamentals. The trend is up. That could be nice. There's a bearish divergence and a bearish profit circle, but that's okay. The trend is up. We probably got a bullish profit circle, which we did the other day. And so that's encouraging. And it did jump up a bit. It doesn't seem super negative. What I want to do today is take a look at the earnings. So first, we can just look at the fundamentals of the company. Trading at $9, that's beautiful. Vonage is, let's see if they're making money or losing money. Negative profit margin, but they have an operating margin. They have a return on assets, but not a return on equity. They have $1 billion in revenue. That's pretty interesting. Earnings, they have earnings. That's pretty good. And they have a bad current ratio, so they don't have enough money to pay their short-term debts. If all of their short-term loans were called due and credit dried up, they would have a problem paying their bills. Oh, short ratio. Not really. Yeah, there's no short squeeze going on either. Short squeeze is when so many people are holding shorts in the company. They've borrowed shares and they're going to have to pay them back, that the bulls start to grab the stock and inflict pain upon the short sellers. And there's so many of them that the short sellers begin to capitulate and the stock goes up. Average volume is high. Price to earnings ratio is not available because they don't have earnings per share. All right, so that's a little bit concerning. So moving on to guidance, says the CEO or CFO. As Alan noted, we're updating the 2020 guidance to reflect the estimated impact of the China virus. We're seeing positive catalysts from growth in remotely delivered services and remote work. Our high product utility is evidenced by exploding video usage and lower logo churn. I think that just means lower customer cancellations, offset by elevated levels of payment deferrals and credits and temporary demand declines in hospitality and travel-related sectors. So that's interesting. So they're saying some stuff is going better and some stuff is kind of going worse. We're seeing some customers accelerate their move to the cloud and others put their decision to shift to the cloud on hold, focused on their own operations. With the visibility we have today, we project the net effect of these dynamics to result in business revenues in range of 855 to 880 million. Within this number, we expect a USF of 17 million. I don't know what USF is. I don't know. Maybe those are usage fees, like, taxes and stuff that a company has to pay in order to give phone service. For consumer, our outlook has increased slightly as we project 2020. As with the business, we're not currently seeing a churn impact. We expect full year guidance of 150 to 155. We can maintain this high level of adjusted EBITDA because the provision to overall revenue is modest 3%. We expect business segment revenues to in the range of blah, blah, blah. Consumer revenues. To be clear, our earnings guidance reflects continued investment in long life assets like engineering and sales capacity, the visibility we have. It's not negative. It's definitely not a negative earnings call. It's not. It's actually, I would say it's remotely positive. So the industry, travel, hospitality, ton of interest in a ton of activity. Basically, these projects, these project now on the top of the list, digital transformation initiatives. The way to think about it, the trends that we highlighted are permanent, meaning remote work is here to stay. That's good for them. Long-term growth, mid-market up. So their bookings are up 62% and growth was 39%. So they are growing. It's a good stock, and you found a good one. I think that this is a reasonably good stock. Now they don't have earnings. They don't have enough cash, so it's a mix, but they are benefiting from the remote work thing. And like 1, 2, 3, 4, 5, 1, 2, 3. So yeah, I mean, I think if we break above $11, I think a momentum play is in available. Or if we break above $10.17, I think I would buy this stock if we could go above $10.17. Oh, there we go. Let's do a speed test. I just want to see if I'm using the. Oh yeah, so we're connected to the high speed. I plugged in the Ethernet cable to the MacBook right over there. Yeah, we're good. Okay, that'll do. That'll do, donkey. That'll do. Okay, Q&A is here. Good morning, everybody. Thanks for letting me sleep in a bit today. I think I could still go back to sleep again. I think I might go and lay down on the couch after this is all over. I think I may get a little bit more rest. That's the name of the game right now for me, is get plenty of sleep and don't get sleep deprivation. That's a bad thing. So that's number one on the bounty. I wanted to take a look at that. BBGI shot up on earnings, overbought, no options. The price is $2.89. Strike zone pattern. And then closer of 3 profit circles. Oh, okay. Let's look at RDUS. Ooh, really nice. Market cap 642 million. They do not have earnings per share. Let's do a Google search for their earnings transcripts. Okay, we've got the transcript here. See if we can find the word guidance. 49 million, blah, 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 48 million in sales. Let us slightly revise down our revenue guidance. We remain confident in our outlook for strong growth once the restrictions ease. Okay. Majority of our clinical sites are open. Okay, I like this. All of our actions have been consistent. Now, guidance, that's not guidance, that's regulatory guidance. Okay, a revenue bridge versus the same quarter of 2019. This is good. Time loss, 48 million, a growth of 61%. Upper side of the guidance range, which was that's great. Revenue growth. Our revenue is highly predicted from the new patient starts. This price improvement enabled us to hit the higher side of revenue guidance. This is a beautiful thing. This is beautiful. Updated guidance for 2020. We expect to deliver net sales in the range of 190 million. We can expect to become market leader by crossing the 50% market share. This is good. Strong momentum. Revised revenue guidance will have an impact. So guidance for cash burn to be slow, below 100 million. That's great. Important to reiterate. We have access to non-dilutive financing. That means they don't have to issue more shares. This is good. They're looking to grow. We're not changing our 3-year guidance for the company. Okay, this is really quite nice. They don't have earnings, but they're a health company. So I really like all the profit circles. There's even daily profit circles, as you mentioned. Who posted this one? John Y. Okay. I like it. I like this rounded bottoming of the stock. I love that. I really like this one. I think they provided some positive guidance. Could be bouncing off of the pivot. It's nice. I think we put it on the list here, and we see if we can buy some of this. Pull it up over here. I don't know why I'm doing that. We can just go here. What am I thinking? Radius Health. See what the options look like. Can we buy some calls? The August calls. It's trading at $13. Can we buy the $12.50 calls? It's not bad. It's a 50 cent spread, 60-cent spread. It's not bad. I mean, I've seen worse. It's not that bad. I mean, it's not great, but it's not bad. What about the October ones? So the spread's wider on those. I don't mind this. What's a reasonable profit target here? There we go. We got some missed pivots way up here, including a savage missed pivot at 24. So if we took until earnings in August, so it's unlikely that it's going to move that much higher. It could get up to the yearly volume weighted average price, and that would be enough to cover the spread. I'll buy some of these. I'll buy some of the August $12.50 ones. I'll just buy one of them. It's $240. Has a 55-cent ask. So it is warning me that I have to pay a little bit more. I'll take one of them. We can adjust this if things get hairy. Okay. What I'd like to do now is just take a quick look at the comments. It's all good mornings. That's perfect. And then what I'd like to do is just kind of look, make a run through some of the instruments that we look at. PDD, it's up on the day, but it still hasn't, it used to just break to new highs almost every third or fourth day, and it's not doing that. It did have a steady decline here, but we haven't had a lot of sideways movement in a while. And sideways movement isn't good. It's not good, especially after this really big bearish engulfing candle. I'm I'm fine with this. I haven't even turned this into a track record trade for the exotics club yet, but it's coming. That track record trade is coming. It's gonna print a bearish profit circle. It's gonna do it. And then I'm going to sell Zoom. It's up on the day, but it's not printing a fantastic looking candle. What's working against me here is that not the fundamentals. The company is not strong. It's the order flow in the market, which arguably is the most important thing. I think Shopify is like the canary in the coal mine. I really do. I think Shopify is this sort of leading indicator of how well the stock market is doing. Because Shopify is it traded for $887 a share. It's a $103 billion market cap. It has negative earnings per share. So it's sort of one of the ultimate examples of a company that really shouldn't be doing as well as it has been in the stock market. And it's definitely worth shorting. It's definitely worth it. And it's one of them. I probably ought to swap out Zoom and use Swapify it. I probably should, but I haven't done that yet. But Shopify is it's kind of a company that really you really can't find any way to justify $100 billion market cap on Shopify. It's also massively bearish divergent on the daily chart. I wonder what the weekly chart looks like. It's printing one of those super giantly indecisive bearish candles on the weekly. I'm going to tweet this out. Yeah, I got to get the link here. There we go. So yeah, I think that's like kind of the canary in the coal mine. It might go first. ATXI, we traded this yesterday, right? It's doing okay. The weekly chart looks really, it looks okay. It looks like a strong candle on the weekly. 4 hour looks good. It's up today. Um, I like it still for all the same reasons I did before. LXRX still in. Reed had a really bad drop today, and it's probably going to hit the volume weighted average price for the year. Cisco still think has a bunch of corrective moving to do. Facebook is up. That doesn't mean anything to me. Score we looked at yesterday, still waiting for that to bounce off of something. And the VXX. I don't know, Jeff, if you're still, sort of bullish the VIX. I still am. I still think it looks. I still think it looks pretty great. I'm down $75 on that one. Doesn't seem to be that big of a deal. On ATXI, I'm up $20. Nothing to write home about or get super excited about. I wonder what Zacks says about Shopify. It's a 3. It's an F value, F growth, and C momentum. It's not a really great number for a company that supposedly has a $103 billion market cap. What the fair value of this stock is? I wonder what Yahoo says is the fair value. Doesn't even know. It doesn't even know. It doesn't even know what the fair value is. What the short interest is here. It's not. It's not. It doesn't even matter. Top shorted stocks. Wow, GameStop. Look at that. Holy moly. Whoa, that's crazy. Short percentage of float, 254. Short percentage of shares outstanding, 87%. Shares outstanding are 64 million. Shares short, 56 million. So this is prime candidate for what they call a short squeeze. Boy, some people like Michael Burry of the Big Short fame. One of the reasons some people like him are so long this stock is they feel like everybody who shorted this stock is going to get absolutely punched in the mouth. And so what happens is the stock starts to go up. Market cap is really low. You know, Amazon could buy GameStop. It's not out of the question. Twitch could buy GameStop probably because Amazon owns Twitch. Um, so what happens is everybody's short the stock. They have to borrow shares and then they sell them, get the cash, and then they owe shares back to the people they borrowed them from. If the stock starts to go up, they got to buy the stock at a higher and higher price so they can give back the stock and close out their trade. Well, if the stock keeps going higher, it's squeezing them. It's like get out, get out, get out. And to close your short position, you have to buy the stock. And it's a self-fulfilling prophecy. You have people buying the stock, and then you have short sellers that are buying the stock to close out their position, and it's a exponentially rising level of velocity. And that's, with that many shares shorted, that's a pretty crazy number. We could probably watch that squeeze. Now, the crazy thing is that it's got so much room to go up and so many missed pivots to go. On the other hand, Match Group, so bullish trend, looking super bullish, already squeezing the shorts, right? Look at the short interest on Match. Fair value, it's trading for 98. Fair value is 49. It's an overvalued stock. But look at the interest short. Short percentage of float, 95%. 41 million shares short out of 74 million shares outstanding. Now, I think Match has earnings. Yeah, earnings per share. They have earnings. They have a PE ratio. It's 50. That's kind of high. It's nothing like Zoom's. I wonder if Shopify doesn't have a price to earnings ratio because they don't have any earnings. It's infinite. So Match is a really interesting company. It does have earnings. It does, these short sellers could get massively squeezed because it's still not all the way into overbought territory. This is interesting as well because the trend is up, the shares are short, and people are going to get rocked here. It's not even bearish divergent again. It's kind of cool. It's kind of interesting. All right. I'll get the recording uploaded for everybody. We'll be back in the afternoon, somewhere between 2:30 and 3 o'clock Central Time. Thanks for being here, everyone, and I will see you soon.